Thank you all so much. We're in luck today because I have assembled 4 people who I actually consider to be friends and people who anyone in RWAs know and look to for thought leadership and also just real strength and sophistication as product leaders. My name's Irene. I am a venture partner at Bain Capital Crypto, which is Bain Capital's crypto fund. Before we dive in, I will let each of our founders introduce themselves. Let's start with Kaledora.
Hi, I'm Kaledora. I'm the co-founder of Ostium. We are building DeFi perps infrastructure for real-world assets.
Hi, my name is Philipp Pieper. I'm the co-founder of Swarm Markets. We've been doing, infrastructure for digital issuance and liquidity since 2017. And we have 2 businesses. One is actually sort of public stocks and bonds on chain. We have a gold product that launched last week, which I think the FT called Impressive Legal Gymnastics. And then we have a second business where we actually give the entire stack to token issuers, token platforms to do their own liquidity and manage that and basically help propagate the RWA ecosystem.
Hello, I'm Sam MacPherson. I'm CEO of Phoenix Labs. We work on Spark. Our best-known product is SparkLend, it's the 3rd largest lending market in DeFi.
Hello, I'm Paul. Co-founded Morpho a few years ago, and we're building lending and borrowing primitives.
Amazing. So to dive right in, the last few months we've seen some really interesting new consumer behaviors. We've seen massive liquidations from the market, institutional entry through ETFs. We've seen rotations out of altcoins and traditional assets into meme coins. And we've also seen, particularly through today's event, upcoming products that are tokenizing real-world assets. Let's start with Kaledora because Ostium is doing something particularly novel with perpifying any asset that has a market. What are some real-world events that you've been seeing or observing that actually impacts the maturity of the market to use products like Ostium and other observations you've had, which you've written about at length on Twitter?
I want to maybe just start by giving a little bit more background on Ostium because I'm not sure how familiar some of you guys are. I mentioned we're building DeFi infrastructure for trading any asset like a perp. I call this perpification, which is a bit of a tongue-in-cheek term in contrast to tokenization, which is sort of the core theme of this conference. What that means is basically we enable any asset. Ultimately, we want every liquid market on Earth to be tradable like a perp. So really all you need to create a perp on an asset is a market to match buyers and sellers, a funding rate, and then a spot price. And so our vision is basically to enable people to use this crypto native primitive, which is a perp, and apply that to other assets, the entire universe of non-digitally native assets on chain. What that looks like today is assets like WTI oil, natural gas, copper on the commodity side, also gold, silver on the precious metal side, and then indices like the Hang Seng or the Nikkei, FX, allowing you to basically trade those on chain like a perp, all settled in cash settled, so in USDC. So that's hopefully the relevant context in terms, just to answer Irene's questions on sort of changes in behavior. I would actually point to, I think, the rise of prediction markets on the consumer side. We've definitely seen this with Polymarket hitting an inflection point and really reaching, I would say, sort of product market fit this cycle, over $100 million in volume in June. And I think this is really an indication of a broader trend where, I would say there's been a vibe shift. I think this cycle has been particularly determined by macro, and I would see this as part of like a larger convergence between macro and crypto. Prediction markets being sort of one great example of this inflection point of people actually wanting to punt on broader macro events, be that geopolitical, political, interest rates, whatever it may be, through sort of these binary betting markets. And I think the way we see that extending out is into less binary markets, into more of these sort of continuous markets, which are on the perp side. And so extending into things like either punting on oil or gold or whatever those other assets may be. Last thing I'll add there is I think the reverse way of looking at this as well is I think we're also hitting an inflection point in terms of the accessibility of on-chain applications for consumers. So not only are on-chain users increasingly interested on sort of betting or trading on things external to crypto, We also see, I think, the gap being bridged increasingly between on and off chain through sort of, the inflection point on account abstraction and gas abstraction, all sorts of things that make accessing on-chain applications easier. I'll pause there. I'm not sure if anyone else wants to comment.
Well, yeah, I'd love to hear from you three about other observations of macro events that have influenced consumer behavior on-chain. Where is the demand for RWAs actually coming from?
Okay, so we might have a little bit of a different opinion than the institutions in the space. So for us, it was, since 2017, it's come a long way. So it's kind of great to see an RWA conference actually happening, because I think for the longest time, for the past 7 years, people weren't really gelling around the use case and asking themselves where actually the adoption will come from. Our answer has been basically that right now it's the on-chain users that are basically there. It's either trading organizations or individual traders or just the general consumer that would never actually open up a brokerage account to actually buy a normal asset. So for them, it's actually about just extending the crypto use case, the tooling, the experience into RWAs. And that also involves just platforms growing into different regions. So this ranges from stablecoin issuers like MakerDAO actually putting a lot of work into actually sort of doing their thing on the RWA side to neobanks being now built on blockchain infrastructure that want to address the African market or other markets that have a specific use case around them. And so our answer right now is that that's where the adoption is. But what we definitely see on our pipeline is actually just institutions taking the next step, actually seeing blockchain not just as the consumer that potentially is a recipient of their products, but more importantly, actually just as an efficiency layer. So you can use the blockchain to actually sort of manage an ETF or a UCITS fund, and actually that suddenly makes it, number one, more transparent, but number two, also cheaper and just generally more reliable. And I think Larry Fink just played that to that very same tune, just pointing that out, that might be actually the next innovation that comes to the financial markets from this realm, and not just us bringing new users into the blockchain world.
Yeah, so RWAs have always been one of the biggest use cases in crypto, starting with stablecoins. They're completely dominant as a use case. And what we see as in 2023, when the interest rates started getting hiked, we see the onboarding of the next RWA, which is tokenized treasury bills. So Maker, as one of the largest buyers of T-bills in DeFi, at peak was about over $2 billion deployed into treasuries. We've seen this trend pick up, and I mean the reason is quite simple: is because people want access to yield. So stablecoins, zero yielding stablecoins made a lot of sense in a zero interest rate environment. But now that the interest rates are higher, people want access to this risk-free rate, and so this is where you see the growth in tokenized treasury bills. I'm a firm believer that we'll continue to see tokenization of RWAs. Like, if it doesn't happen, then crypto is forever a fairly niche industry, and if we want to grow several orders of magnitude, we need to tokenize the entire world basically and get access to this capital efficiency.
Paul, I was actually just about to ask you, Morpho has launched new products like Metamorpho, Morpho Blue over the last year, and has certainly captured attention and usage across all of DeFi. Very, very impressive. Is there something in particular about the macro environment from the last year that has supported this? And also, we'll get into the partnership with Maker and Spark. Could you share more about, from a founder perspective, what has been unique this last year?
Right. So I think with interest rates being lower in crypto than in traditional markets last year, it really brought a new wave of we need those treasury bills on chain in order to get those rates up, in DeFi in general, and that brought a big generation, a big impulse of funding rounds and RWA projects that have been building and are still building, and we're starting to see that the results of this. Today, with many different projects launching, very exciting models on how do we bring yield-bearing stablecoins, how do we bring treasury bills on chains, under what jurisdiction, and really the way I think of the short-term use cases. Long-term, I agree that we need to bring all of this on chain, and that's other than that, if we don't do this, crypto will remain very small, but short term, really, I see the biggest use case as being rate, like maintaining a base rate for DeFi rates whenever like the market is a bit less bullish. So right now, crypto rates are driven by demand for leverage on like Bitcoin or ETH, etc., and that drives the interest rates to like, let's say 8 or 9% on average these days. But whenever like the market is less bullish, you know, those interest rates can go down and below the treasury rates, and this is where RWAs come in. And I anticipate that whenever like the interest rates of crypto will go down and below this rate, when we'll have a massive adoption for, you know, to me, that would be the next impulse in like the adoption of treasury bonds in DeFi markets at least. And we already like tend to see this like in Morpho, like the way the adoption we've seen for real world assets is essentially risk managers, so people running like lending vaults on Morpho, where they're preparing their real-world assets like use case for whenever the rate is going down, they switch the activity to real-world assets, and to ensure that at least you get the TradFi risk-free rate when you're operating in DeFi, minimum. And then in best cases, you get the crypto rates.
I think the audience would probably benefit from hearing a little bit about the unique architecture of Morpho and where it fits in for lending and borrowing. What would be interesting, actually, is hearing from Sam. You guys merged in a really interesting way for one of these vaults. Could you speak more about that, what that partnership is, what it allows, and why you chose Morpho?
Yeah, sure. So a bit of background first. So we launched SparkLend in May 2023. And so this is an Aave v3 fork, which has been very good for specifically Bitcoin, ETH, and derivatives leverage against USD. This pooled liquidity model has been pretty good so far, but as we get more different types of collateral, RWAs, and in particular, Athena is the integration we did with Morpho. There is a need for isolated markets because you know, having two completely unrelated collaterals getting charged the same borrow rate, same LTVs, doesn't make any sense at all. So in order to scale this system up, you need to have these isolated markets where you can set different LTV numbers and you can charge different rates. So the reason we went with Morpho for, and this is for the Athena integration, Athena, the basis trade was yielding about, I think it was even as high as like 80% or something crazy, like back in January to March. It's definitely cratered now, but it was yielding so much, Maker wanted access to this yield. And it's a fairly big capacity. You know, we're talking on the order of, you know, 100 billion-ish on that order of magnitude. So Maker's size is only 5 billion, so tapping into this was extremely important for a revenue generation strategy. And we could forward part of that yield in savings DAI, which is the yield-bearing version of DAI. So with the Morpho vault, we were able to capture most of the yield. We offer over-collateralized vaults against USDE and SUSDE. You know, average LTVs 80-something%. And so the users of these vaults are able to capture this extra yield if they're in Athena and they want this boosted yield. Maker gets very well protected, safe, captures most of the yield, but in exchange, there is this over-collateralization layer of protection, which is very important for DAI holders. DAI is, you know, not meant to be the highest yielding risky product. DAI is meant to be a stable coin that is always liquid. You can use it as cash. And savings DAI, we want to forward what is the best risk-adjusted yield possible in DeFi. We view savings DAI as the savings account of DeFi. And so what this means is optimizing for both liquidity and yield. So we keep a 25% cash reserve in USDC to make sure the peg keeps. But we can also tap into these yields when they present themselves within the market. And Morpho in particular was useful for this market.
Evidently, technical advancements like, for example, Morpho's new products and decision to choose an immutable architecture, which we'll talk about later, have allowed for these new user experiences. There's also been regulatory convergence around this. And Philipp, we spoke briefly about your perspective as founder of Swarm on what that convergence is with macro and technical changes. Can you speak to the regulatory side?
I think, you know, obviously sort of we started in the US and then actually gradually moved over to Europe in 2018-19 just because we found the the frameworks here to be, or the regulators to be willing to put more frameworks in place to look at it more holistically, and actually sort of, starting with, Liechtenstein and Jersey, but then suddenly, eventually, actually sort of Europe and Germany maybe at the forefront, started to go into that direction as well, which then became sort of a blueprint to then actually formulate MiCA from. And I think that, looking back for the last 6 years, we've been obviously sort of now in a position to give a lot more confidence to players engaging. We, not that we have all the answers how MiCA is really going to unfold and whether the regulators are on par with actually sort of delivering that in a good way and what the next version of MiCA is, but it's actually really great to actually have something in place, to have the confidence that basically, we know what the asset is. We actually are being held to the truth as a regulated entity to actually do that in a good way, to publish disclosures about the asset, to actually sort of be at that verge between blockchain and traditional financial world and make that in a way where we don't have to hack it really, but we can do that in a way that people gain confidence. So as much as we've seen a lot of these assets that we talk about already being done over the years, I think now it's about taking the next step and actually going to the lower levels of actually trust. So, when we launched the gold product last week, it was basically also a response to some of the questions that we got, basically, that, you need actually the reliance that the gold bar is there. So we put, an NFT representing a gold bar that is sitting with Brings, is purchased by StoneX, and it actually belongs to you. And it's a pledge to you, and it's not on our balance sheet. It's not that we can actually do anything with it, right? So you have to take that next step and maybe even go the next step after that to say, oh, I want to know where it's actually stored, and make a decision basically to say this should be now in Switzerland or Dubai or wherever. And it's that flexibility, the transparency of the off-chain representation that is also really needed, right? So we were talking in 2 panels ago actually sort of about attestation of data. We need to be held reliable that the token itself represents and is attested to with data what it actually represents, and that all the workflows that are connected with the token actually are figured out. Redemption processes, how does a stock split work? How does a dividend distribution work? Everything that needs to be put into a prospectus now has to be declared. And I think that's the result of not just MiCA, but also MiFID, and the regulators getting their head around what that all means, that we can now all benefit from. Not that that all's great. It will actually require changes of the space, but actually we're very, very excited that actually this blueprint of Europe is at least marching ahead, and we can help navigate that. And I'm sure that America and other regulatory environments are taking a very close look how that works out, and whether that will lead to the traction and adoption by a regulated space.
The transparency infrastructure piece is incredibly important more broadly for composability, which I'll be asking you all about, which is really how do these tokenized RWAs interact with other protocols. Kaledora, we've spoken before about how Ostium is competing with incumbents, let's say CFD providers, and some of the long-standing issues with these platforms is around lack of transparency. What are the technical challenges that protocols like yours need to overcome to actually be competitive and better than existing traditional platforms like those?
Yeah, this is a great question. I'll actually just focus specifically on oracles first and maybe going to some of the other aspects of the user experience. I often hear surprisingly little discussion about some of the challenges to bringing a lot of these assets on chain that arise specifically from having a reliable price feed or actually having any price feed at all. When we set out to build Ostium, we sort of initially built out the on-chain infrastructure before at some point having, I guess what I would say, a come to Jesus moment, realizing that we weren't, we kind of needed to in-house the data sourcing for things like oil or natural gas or copper, simply because there is no price feed today. It does not exist on chain. And so in terms of sort of like technical challenges to overcome, most of this is related to, like, a lot of the discussion on oracles tends to focus on sort of like consensus or like how do you construct like a verifiable oracle network, which I think is a maybe separate discussion. And what we spend a lot more time on is like, where do you actually source the data? Like, do you get it from an exchange? Do you get it from a third-party data provider? How do you aggregate it? How do you deal with out-of-market hours? Like, what price do you report if the market is closed? If the quote-unquote spot price you're referencing is a future, obviously, like for oil, this is the case, right? There's no liquid spot market on oil. It's the front-month future people are usually talking about. How do you reference that? Like, are you referencing a specific contract? How do you aggregate that data? These are all like pretty thorny questions that are more like traditional financial market data questions rather than like Oracle consensus mechanism questions. And so we spent a lot of time on that. And I think that has been a core. We wound up basically in-housing this. We worked together with Stork, Oracle, if you guys are familiar with them. They sort of run our nodes and run an aggregator for us to ensure transparency and a lack of bias in the sense that we can't sort of like meddle in the price. But the underlying construction of how those feeds are aggregated and where we source that data, we in-housed. And that has been sort of perhaps the core technical challenge for us. You need, I mentioned this earlier, but just to reiterate, if you want a perp on an asset, you need 3 things. This is an oversimplification, but you need 3 things. You need a market to match buyers and sellers, you need a funding rate, and you need a spot price. And if you don't have a spot price for the asset, you can't create a perp on it. So that's, I would say, is like one of the core technical challenges that I think is generally underappreciated, and maybe for good reason, because most of the focus is on like tokenization. So you have some off-chain entity that is like holding the asset, and you're relying on some arbitrage mechanism between minting and redemption to peg the price. Whereas in our case, where you're relying on basically arbitrage based on the sort of spot price that's being referenced from off-chain in order to ensure that sort of basis trade basically is going on in the same way that you would have a basis trade between an on-chain crypto perpetual and an off-chain perpetual. So that's on the technical side. Hopefully that answers your question.
You guys have impressively achieved this for like soybeans and cattle and cocoa. I like hilariously tested out the platform and was able to short soybeans, for example. That is incredibly exciting and fun.
Yeah, you can short lean hogs on chain on Ostium. So, you know, do that.
Sam, go ahead.
Yeah, I was going to talk a little bit about composability, because I'm a big believer in you know, trying to do things better than the ways things have been done in the past. And so with savings DAI, as compared to the other larger stablecoins which pocket all of the risk-free rate, we have the view that this should be forwarded to the users. As the holder of the asset, they are taking most of the risk and therefore should be forwarded the risk-free rate. And with DeFi in particular, the composability within the space allows you to you know, do DEX trading, stuff like this. You can anchor it with a yield-bearing stablecoin as opposed to a non-yield-bearing version, which is much, much better for in terms of opportunity costs. And we were talking about like prediction markets before, right? It's much, much preferable to be locking up a yield-bearing stablecoin where you're issued this risk-free rate, so you do not have this extra opportunity cost for like locking your money up in a prediction market or something like that. So I think it's important. We do not want to just recreate all the bad aspects of TradFi. You know, I think it's important. A healthy economy, empowering users to get more with their capital, I think is important to make the entire world run better.
There are some really key design decisions that have to be made when you're constructing protocols like these with all of the technical challenges that you two just shared. Paul, previously before Bain Capital, I was head of strategy at Layer 0, and our approach to writing and deploying smart contracts has always been immutable, and there are really significant security implications because of this. Morpho mirrors a lot of these design and engineering beliefs. Can you speak more about some of those key design decisions, how that is actually quite unique across the lending and borrowing space, and what that means for composability? Right.
So before doing the current protocol that we're doing, which is Morpho Blue, we used to build actually on top of other lending and borrowing protocols and optimizing them. And around the time, we learned a lot about what it means to actually build on top of like DeFi infrastructure and composing on top like lending markets, for example. And it turned out to be very hard. Like, for example, you know, existing lending and borrowing markets like Aave, they are upgradable. So whenever they want to change, you know, something on their code because, you know, there is a bug or there is something they want to change or add, well, as a protocol built and composing on top of those lending markets, you have to essentially make sure that every single line of code that they're changing is not going to affect your protocol in a way that's bad, right? It could even be critical. And you know, they have like time logs for those changes to be updated, like 10 days, but 10 days is not even close to be enough to like audit your protocol and the changes that are made if you're building on top. And with 2 years building on top of Aave and Compound, we've came to become like immutability maxi when it comes to market infrastructure. Because immutability really is the only thing that gives sufficient trust for builders to actually rely on you forever, right? And I believe that we are yet to Uniswap got this very early in the space, and many of the other financial applications are much more complex than the one mono-dimensional trading infrastructure. So we've had a hard time finding what are the right primitives and how we could make them immutable. But I really think that over time we will be trending towards ossification of the code into very immutable primitives. And only then we can have reliable infrastructure that actual institutional players can truly rely on, right? And if you talk to institutional or even just fintechs or distribution partners, if there is this upgradability code and it's governed by token orders, it's much harder for them to step in and to build with confidence on top of those primitives. So that has driven a lot of our conviction around immutability. I'd say the other design challenge, which Sam has talked about a little bit, is risk isolation, especially when you start to have assets that have risk profiles that are very hard to price on-chain. So what I mean by that is, for example, when you're liquidating a position, the way you're going to get the liquidity for that liquidation can vary a lot depending on one real-world asset from another or from one crypto asset to another. And pooling liquidity the way we've been with crypto assets, where every asset is liquid on a DEX, etc., obviously does not work as well when you have T+2 settlement period to get access to very deep liquidity. And so you have to factor all those complexities into your system. And one way we found is essentially build very primitive protocols that are isolated, on top of which you can rebuild the specificities that you need for each asset and the necessary aggregation layers to limit the downsides of isolation.
Is there anything the three of you would want to add on top of those really actually essential points around security and design challenges that either enable or inhibit composability?
I'll just add, so it's very similar, but with a different motivation that we went down very similar routes. For us, it was we have a regulated walled garden approach to building pools and something called DOTC, which is smart contract based collateralized trading. But then, in a certain way, once we actually saw some of the regulatory, decisions that were made, that were communicated to us, we saw the opportunity to actually put that into a non-governed smart contract route, which we have no control over. It's basically out there, and we now allow a lot of RWAs actually to quote their own prices. It will get a major improvement this week, but I think that's the way forward to actually give the outside world a lot more reliability and confidence that it's not us as a counterparty that has any kind of influence as a middleman on any part of that kind of system, and we can just improve it in different versions and not actually sort of upgrade the existing version, but allow people to make choices to move to the next version, which is then again non-governed. And I think that's been obviously downplayed by a lot of DeFi players in the past, where a lot of those system components were not as decentralized as the name implies. But I think the next step will definitely sort of benefit from the fact that we are taking that next step in the industry to make that building blocks that can be used by whoever decides to use them.
Yeah. So security is by far the top priority that MakerDAO takes into consideration. So Maker, as one of the first projects in the space, has preferred immutability. The core contracts within Maker from the very beginning are not upgradable. They're set in stone and they'll remain there until the end of time. When we look at protocols and we do evaluations of moving liquidity into the wider DeFi space, things like immutability, as Paul said, is a very, very important feature that we look for. It gives us reliability. It means we do not have to trust external entities based on what they say. We can just look at the code. We have smart contract developers. Morpho Blue in particular is 600 lines of code. Our due diligence process on that was quite easy, just by the simplicity of it. So immediately we had high confidence that this was a safe protocol to lend to. So yeah, I think so there's definitely trade-offs. I think there's places for upgradability. It can make sense in some spots. But I think as a general rule of thumb, it's important to prefer immutability. And at Maker, we've done that from the beginning. You know, trust is built over a long time, and yeah, we've taken it very seriously.
I wanted to just make one more comment on security, actually piggybacking off of something that Paul said briefly about like T+2 settlement times. And it's the interplay between sort of security and how you do things on chain and the unique features of real-world assets. What you mentioned, I mean, you guys decided to not focus on that and allow other people with more specific knowledge to run their risk models and decide how they account for those sorts of features of the underlying market. On our side, this has definitely been another sort of major technical challenge, and I would just point to one example in particular, which is market hours. So, you know, like FX trades 24/5. If you have a price feed that comes in, you know, unlike a perp on, say, DYDX or something where you have a 24/7 price feed, what do you do if there's no price feed on the weekend? You know, you could allow continued trading, and then you'd have a stale spot price, which obviously is risky. Imagine there's some, you know, major move over the weekend, or there's some major news that comes through where people are getting an execution price that is not actually what should be the correct execution price. You know, or you can block trading, but like, how do you do that in a way that is, you know, the most decent? I think it's actually tough. I would maybe make the claim that I think if you're dealing with non-digitally native assets, or until we get to a world where these assets like exist digitally, like natively on chain, I actually think it's almost impossible to do it in like a fully immutable or like fully trustless way. There's always some trust component, but how do you try your best to approximate that is like not an easy question to answer. In our case, what we came to, which like, you know, hasn't really been done before, is we basically decided to just move that market hours data down to the Oracle level, so we don't introduce additional trust assumptions beyond those of the Oracle. So the price feed itself is including in the price feed on like what is the asset, what is the midpoint price, what's the bid and the ask. It also includes like a data on whether the market, like a Boolean, like is the market open or closed, which is like a lot better than I think what has been the status quo with some experimentation in the past with listing some of these assets on chain, where it's basically just a block on the front end and usually coming from like one API that you have to trust or like manually implemented by someone. That's just like one example, but I think the specific interplay between like how do you deal with the features of the underlying market if that's the reference market and you're creating either a tokenized or a perpified version of the market on chain, and security is a pretty thorny question. I don't think there are any like right answers, but that's something we spent a lot of time on.
I so appreciate that from all four of you. You are very product-focused founders, and several of you are engineers yourself, because oftentimes for panels or discussions around real-world assets, we are discussing ideas and overall trends and movements, entrance from the traditional institutional space. But these design challenges and also aspirations on the engineering side to be concise, elegant, succinct with your code, and also immutable where you can, thoughtfully and tastefully upgradable where it makes sense, is the stuff of building a protocol that's actually generational, that persists beyond 2 to 4 years. So the insights from the four of you today answering questions around design challenges is unique. And if we have any developers in the audience, I personally would love to hear more from you, and I think more platforms to actually discuss the nitty-gritty is important beyond just macro trends. So as we near the last 5 minutes, I want to ask each of you, Coinbase announced in Q1 that they plan to diversify beyond traditional crypto assets and altcoins and offer gold and oil futures. How do you view this announcement? And also, what do you believe needs to be built or adopted from either traditional organizations or new ones? Is it bullish? Is it bearish? Does it even matter for the trajectory of what is possible with DeFi?
I'll take this one. I think this is particularly pertinent to what we're building. For one, I'm super excited about this. I think a lot of what initially is difficult when you're trying to bootstrap a new market for something on-chain that doesn't really exist anywhere else is the arbitrage that is critical to maintaining sort of like the price stability and funding rates within normal acceptable bounds. Just to sort of wrap your head around what that looks like, in the same way that someone might be running a basis trade between, if open interest is skewed long on-chain, on a on-chain perpetuals protocol, they might short, collect funding, and then hedge themselves out by holding spot off-chain or on Binance or wherever that is. The same would be true for anyone attempting to run that sort of trade on Ostium and then some separate platform. So if gold is skewed long, you might want to short gold, collect funding, and then hedge out your price risk on gold off-chain or somewhere else, either by holding Pax Gold, for instance, or some other tokenized gold product, or or actually on the underlying market. Gold is, I think, a good example where this is sort of possible, either staying on chain or there's existing infrastructure. For something like oil, there is no centralized crypto exchange that most of the people who are capable of running this sort of basis trading actually plugging into on-chain infrastructure, which is a small subset of existing firms that would run these sorts of strategies. There is no other centralized exchange where they could run the other leg of that trade. So for us, that's super heartening, and it makes it a lot easier, at least for those two assets, for someone to help ensure the balance across the system that's critical for what we're building to function. The other point I would make is, I referenced this in the very beginning of the panel, but this increased convergence between macro and crypto. It sounds maybe really high level, but I really do think it's true. I think the major drivers of this cycle have been increasingly macro. You see this reflected in the trading behavior of people on chain, but also just honestly in crypto Twitter sentiment and what people are talking about. I think you see more people talking about Powell and the Fed and geopolitics and what's happening in the Middle East or wherever than you've seen in prior cycles. And so I think this is part of just this more data support. I think what we're seeing is a general trend where I think the centralized exchanges and maybe the on-chain exchanges will try to become these super apps that offer trading on every liquid market on Earth. That's our North Star.
Any last thoughts from you three around either the announcement on Coinbase's side or the next 6 months, what you hope will be built, things that your team is pushing for, announcing, or broad observations around tokenized real-world assets?
Oh, no, go for it. Oh, thank you. So I think for us, it's mostly been KYC primitives, and in particular, how two KYCs can be comparable with one another. What I mean is that being able to bring your KYC on chain and different forms of KYC, because you could do it from different venues, but also as soon as you have this, how do you make one KYC included in another? And I know it's a very computer scientist approach, and it's not how it's done in practice. You can't delegate KYC that easily. But for the efficiency of markets and being able to build markets where users can aggregate on the same infrastructures, it's very, very important that at some point KYCs become comparable with one another. And there is to us, we believe there is a huge market opportunity in just this. So yeah, definitely something I would love to see soon.
Yeah, so for us, on the supply side, we want to see new uses for loans. Primarily, the loans issued right now are used for crypto speculation. Would like to see more the use cases mature more in that regard. So seeing new types of RWAs come online and just better integration with the traditional finance system is what we're looking for. But so what we're focused on in the next 6 months is we view the DAI savings rate, currently 8%, as the savings account of DeFi. And so we want to expand this cross-chain such that people don't really need to think about it. You want to get a safe yield in DeFi, the DAI savings rate is where you go, and whatever chain you're on. So us as a technical team, this is what we're going to be focused on in the next 6 months.
Fantastic.
So two directions. One is actually composability. I think we're going to see an explosion of composability for RWAs happening, and that is obviously also benefiting from the fact that once it's digitized, obviously the subsequent interactions actually can benefit from a lot of the like I would say, tinkering that we've been doing in the space as a category to actually get DeFi to where it is today. I think that there's proven protocols that have proven to be actually reliable and good, and I think that can actually sort of apply now to RWAs if constructed in the right way. But the second thing is actually getting, in the other direction, getting actually sort of the smart contract to allow us to actually do something with the real world assets. So in our case, I was referring to sort of gold. You will be able to say where to store it, and actually the logistics are going to be happening with Brinks as one of the main vaulting companies out there. And the smart contract can actually allow you to make that decision, and the interfaces of Brinks allow that to actually sort of be determined on the other end. Now, what we need more is actually better banks and banking technical interfaces to do the same thing, with stocks and other financial instruments. And that's where I think one of the elephants in the room is basically with the Bank of International Settlement and Basel III recommendations. There's obviously the 1,250% risk, capital risk that actually now for certain assets will have to be stored. I think that's going to make it really prohibitive for some banks to actually get involved in the space. So it's up to us as a category to either make a conscious decision to actually go into the banking direction, doesn't mean full banking license, or actually sort of to find banks that are sort of adjacent to that, are not really taking that step and working with that. But that's going to be a huge challenge.
Very interesting. Well, Paul, Sam, Philipp, and Kaledora, thank you so much for your time, and thank you everyone for staying and listening.